Many investors are likely not even aware of it yet, but regulators, Congress, and the White House have all recently announced moves to support what many have referred to as the democratization of alternatives in private investments. What that means for most investors is that investments like hedge funds and private equity, long off limits for all but big foundations, endowments, pensions, and the super wealthy, are about to become much more accessible for everyone. Like a lot of things, the rules originally governing who could invest in these alternative strategies were well-intentioned. They existed to protect investors and ensure that only sophisticated investors, those with the financial means or knowledge to analyze the investments, would be able to access them. The problem was in the underlying assumption that only investors of a certain net worth or asset base could be considered sophisticated. As someone who is a chartered financial analyst and a chartered alternative investment analyst, this never sat very well with me. My education, credentials, and experience didn't matter, only how much money I had. In general, I'm all for making private markets more accessible and think it's long overdue. I do, however, have some reservations, and that is why I wanted to do this video now. I suspect investors are going to hear more and more about these investments and may even see them as options in their 401ks at work. As interesting or even exciting as some of these investments may sound, I think investors would be wise to walk before they run. I can't cover all the things an investor needs to consider today, but I do want to touch on a few. One of the most worrisome things to me is that most of the new fund vehicles being introduced contain illiquid private investments, yet also offer regular liquidity. These funds have a potential liquidity mismatch and violate one of my own personal investing rules in that the investment fund or vehicle should never be more liquid than the underlying fund investments themselves. When I see something like this, I basically assume that it's probably not a matter of if it goes wrong, but when. Keep in mind, we've already seen this play out not that long ago with a very well-known private REIT fund. My other concern for investors is just around setting realistic expectations. A lot has been made over the years of the success the big endowments and family offices have had investing in private markets, specifically private equity and real estate. But investing like them and having the same success is easier said than done. Those big institutional type investors have a massive advantage over other investors when it comes to capital, time horizon, fund and manager access, due diligence, and experience. Let's look at the first two, capital and time horizon. A lot of these institutions have large amounts of capital to deploy with nearly perpetual time horizon, which means they can allocate often 50% or more of their capital to private investments, something very few individual investors can or should do with their own portfolios. Institutional investors also have a considerable advantage when it comes to manager selection and access. They have the experience and resources to do the necessary due diligence, and in many cases have developed relationships or networks with top-tier managers who quite often are close to new investors or who aren't available in the new products coming to market now. Ultimately, I think the changing landscape and greater access will be a good thing in the long run. Done thoughtfully, investing in private markets can be additive to returns. We'd simply caution investors on moving too quickly and not understanding the differences as compared to investing in traditional stocks and bonds. The pitfalls are just different. You'll have less liquidity, the fees are almost always higher, and even the pattern of returns will be different. Access is great, but access alone won't translate to better outcomes. As always, thank you for watching. If you have questions or would like to talk about your personal wealth management needs, please contact us at the number or email shown at the close of this segment.